You know what the most powerful thing in the world is? Is it the Hulk when he's angry? Is it this thing called quasars that scientists discovered somewhere in the universe? Is it Goku?
It's over 9,000!
It's none of these. The most powerful thing in the universe is actually your credit score. The most important thing to your financial health and your financial well-being. A good credit score alone can save you thousands of dollars and is very crucial in reaching all your financial goals, whether it's buying a house, buying a rental property, or even becoming a millionaire. Today we're going to go over what it takes to have that perfect credit score that everyone's wishing for. And if you stick around to the end, I'm going to show you how you can get a free credit report to see where your financial health is today. So what is a credit score? A credit score is basically a report card for your credit history. This score is used by credit card companies and other lenders to see if you're someone who's good to lend to. Your credit score can range from anywhere from 300 on the bottom end to a perfect 850. If your credit score falls within 300 to 580, that means you have a poor credit score. Anywhere from 580 to 670 means you have a fair credit score. 670 to 740 is a good credit score. 740 to 800 is a very good credit score, and then 800 to 850 is basically a perfect credit score. Usually you want to be above that 740 range within the very good or even the 800s with a perfect credit score. Like I said, having a good credit score alone can save you thousands of dollars, because if you have a poor credit score, you're going to be charged more interest, and that's more money out of your pocket that you're not building towards equity. But if you're on the higher end, you're going to get a better interest rate, it's going to save you money, and you would have an easier time getting approved for whatever loan you're reaching out for. These scores are determined by your past money activities. If you're over here panicking, thinking, oh my god, I'm never going to get approved for a loan, I have a terrible history with money, don't worry, I'm going to show you a few ways on how you can get that score back up. But first we need to understand what goes into determining your credit score. Well, the first thing is the most important in the majority of your credit score, and that's your payment history. The payment history is actually the biggest part of your credit score and takes up 35% of the score. In order to be someone with a good credit score, which in turn means a good person to lend to, you obviously have to be someone who makes their payments on time. Would you want to lend to someone who has a record of not paying people back? So what does payment history mean? An on-time payment doesn't necessarily mean paying your whole balance off. This just means you're making your minimum balance every single month. So depending on how many payments you've made on time, you fall in one of the four categories. The first category is perfect, and that's obviously if you're making 100% of your payments. The next one is if you're making 99% of your payments, that's considered good. 98% would be considered fair, and then anything below that would be considered poor or bad and something you need to work on. And if you're wondering what do these percentages mean, it's not that hard to figure out. Simply put, if you have one credit card and you've had that credit card for 1 year, that means you've had 12 opportunities to make a payment on time. If you make all of those 12 payments on time, that means you have 100% on-time payment history. Now say you have two credit cards for 1 year each. You now have 24 months or 24 opportunities to make a payment. So if you've missed one payment on each month, let's say you're out of town and you forgot to make your payments, that means you've made 22 out of 24 of your payments on time. That puts you at a 93% on-time payment history. And as you can see, 93% is a lot lower than that 97% for the poor or the very bad payment history section. So by missing two payments within 2 years, it could tank your credit score. Not only does the amount of payments you've missed affect your credit score, but how late you were on those payments also has a factor to do with that. If you're 30 to 60 days late on a payment, it could tank your credit score, but you could recover from it. If it's between 60 and 90 days, that simply could disqualify you for future loans. And if you're 90 days late on that loan, this could be sent to collections, and we all know collections is the place where you do not want to be. This will just destroy your credit score. The next portion that affects your credit score is your credit utilization rate. Credit utilization rate. I think I said that right without twisting my tongue. Anyways, the credit utilization rate, or the credit ratio, is basically the ratio between how much credit you're approved for and how much you actually use. So if you have a credit card approved for $10,000 and you carry a balance of $1,000, that means your ratio or your credit utilization rate is 10%. If you are only approved for $1,000 and you have a balance of $1,000, that means you're using 100% of the money that you're approved for, and you don't want it to be that high. See, lenders want to see that they're able to approve you for higher limits and you're not just spending every single dollar. If your credit utilization is between 0 and 9%, that means you have an excellent rate. If it's between 10 and 29%, that's very good or above average. If it's between 30% and 50%, it's fair or just below average. But if it's anything above 50%, that means it's very bad and you need to work on that. Ideally, you want to be under the 30% rate, but the best situation would be to be under that 10% rate or in the excellent bracket. This doesn't mean that you can't spend more than 30% on your credit card. This just means that if it's over that 30% and is carrying that balance into the next month, make sure you're paying that down below that 30% or ideally below that 10%. And if this is one thing that you struggle on, there are a few ways that you can raise your credit score by lowering your credit utilization rate. The first one is paying off your credit card. This is an obvious one, but if you want to lower your credit usage rate, just Lower how much you use your credit or pay off more of the balance than you usually do. If you're carrying less of a balance, you're gonna have less of a usage rate. The next one could be ask for an increase on your credit. If you're approved for $10,000 and you're always using $5,000, you can ask your credit card company for a raise on that limit. So they can raise it to $15,000, $20,000. A few things to note about this method. By raising your credit limit, sometimes you can get declined, and then other times they usually run your credit or pull in hard inquiry, which could be harmful to your credit. So by raising your credit limit, you could harm it in a different way. So be careful with that one. And then another way that's similar to the method I just said is opening up a new account. I'm not saying go open any random credit card, but if you're in the market for a credit card, this may be the time, because then it's going to increase your credit limit and in turn lower your credit usage rate. But again, with opening up a new account or a new card, you are going to have a hard inquiry on your credit report now. The next 15% that affects your credit score is your credit history length. So if you've had credit cards open for longer, this shows companies that you're reliable and you can maintain those cards and you can keep them open. So this credit card history length is basically how long you've had your credit cards open on average. So if you only have one card of 10 years, this means your credit length history is 10 years. So if you have that same 10-year credit card and then you go open one that same day, you now have one that's been open for 10 years and one that's been open for 0 days. And now your average history length for your credit is 5 years. An average credit history length over 9 years is what we would consider excellent. Between 7 and 8 is above average or very good. Between 5 and 6 is fair, and then anything below 5 needs work. So again, if you're trying to fix your credit, a few things to consider with this. Number one rule with credit history length: never, ever, ever close your first credit card. The reason for that is because that's your longest opened account. So if you close that credit card, it's going to have a big impact on your credit score. The next 10% of your credit score is affected by your credit mix, or what types of accounts you have and how many accounts you have. Having a variety of accounts or credit card accounts is actually good for you in your credit score. According to Credit Karma, if you have 0 to 10 accounts open, that's on the lower end and you need work. If you have 11 to 20 cards open, that's good or average. And if you have over 21 accounts open, including loans, mortgages, credit cards, student loans, that's actually excellent. To me, 21 credit cards, 21 accounts seems ridiculous. Thankfully, this is on the lower end and it's only 10% of your score, so don't go out there and just open credit cards to get to 21. That's definitely not what you should do. But over the time, as you get older, you're going to open more cards, credit cards, new accounts, new mortgages, and that will build up to the 21 on its own. Now, I believe we've covered 90%, and that leaves us with the last 10%. And this is what I mentioned earlier, and that's hard inquiries. See, whenever you go to use your credit, you actually get a hard inquiry in most situations. So if you're going to get a loan, they're going to pull your credit and that results in a hard inquiry. This means someone looked at your credit to see if you qualify for a loan. So if you have 0 inquiries, that's excellent. If you have 1 to 2, that's good. 3 to 4 is fair. And anything above 5 needs work. So if you have more of these hard credit pulls, it's actually bad for your account. But see, it's weird. If you have less hard inquiries, that means you've used your credit less. But if you use your credit, you get a hard inquiry, and then your credit score goes down for using your credit. It doesn't make sense to me, to be honest. You have to build your credit, and then in order to use that credit, it's harmful to your credit. But on a good note, if you have hard inquiries on your account, usually these drop off within 2 years, and then most of the time they don't affect your score after 1 year. But like I promised you guys earlier, there is a way to check your credit report online for free once a year. And you can do this by going to annualcreditreport.com. And when you go to this website, you're going to be asked to put in some personal information, your social security, your address, your date of birth, and a few other things. And you may feel sketched out by putting this information into a random website, but I've used this website myself. No, I'm not sponsored. This is just a good resource for you guys. I'll put the link below in the description that you can check it out. But when you put in your information, it's going to pull up your credit report. Unfortunately, you're not going to be able to see your credit score, but you're going to be able to see how many hard inquiries there are on your report, what your credit usage rate is, and everything else that we covered within this video. And then if you find something that doesn't belong, you can also dispute these and in turn improving your credit score. So to go over how to improve your credit score, you want to make sure that number one, you're making all your payments on time. That's the most important thing. If you cannot afford it, do not put it on your credit card thinking that you can pay it off. You also want to make sure you're staying under that 30% rate for your credit usage rate, under 10 if you're able to. A tip that I would suggest to get this lower is if you're buying something expensive on your credit card, that's completely fine. You can reap all the benefits. You can get the points, you can get the warranties, but make sure you have that money in cash to bring that balance lower than 30%. Another tip to improving your credit score is avoid opening unnecessary credit cards. A lot of the times when you go to these department stores, they're going to bring you into their credit card by offering you 10% off, 20% off, one time 30%. Try to avoid these no matter how enticing it is, because most of the time you're going to use these once. It's an unnecessary pull on your credit, and that's going to end up closing because you never use it, and it's just going to harm your credit score. And then lastly, another way to improve your credit score is, like I said, keep all your credit cards open, especially if it's your first one and if they have no fee. If they have an annual fee, what you can do is call up your credit card, say, hey, I want to actually cancel this. Are you guys willing to waive the fee? And if they don't, you can also downgrade to a free card. By eliminating that fee on your credit card, you can keep it open for however long you want, and that will only help your credit score. So today we went over a few tips on what affects your credit score, from payment history to credit usage rate to credit mix and a few other things. I also went down to give you guys an idea on how to improve your credit score. And then lastly, we also went over a website that you can get your free credit report once a year. So I hope you guys enjoyed today's video. Let me know your thoughts down below. Share it with a friend, comment, like, subscribe, and I hope to see you guys in the next one when we all have the 850 credit score.